Welcome back to Markets at Noon right here on ET Now, and let's welcome on board Jigar Mistry, who's the co-founder of Point Capital, joining us on the show today. Hi Jigar, good to be speaking with you yet again. And firstly Jigar, once again, the markets are a little jittery. It's the rise of the geopolitical tensions. It was not just Iran and Israel, but now US also making an entry into that. Give us your sense, how do you see the markets plays right now, and what's your take on Indian markets?
Hi, Shrishti. Thank you as always for inviting me to your show. I think, see, geopolitical tension aside, and I'll come to that, but I think until sort of September 24, the things, if you take a long-term CAGR of, say, 3 years, especially in the small cap index, the share prices were moving way ahead of fundamentals. Now, by February, you had essentially a situation where the small cap index corrected 25%, and that resulted in a reasonably decent equilibrium. However, post sort of starting March onwards, we started seeing a lot of FI inflows come through to India, predominantly driven by the dollar weakness. And I think that has resulted in the upping of the risk appetite, so to speak, even within the domestic investors, which again started resulting in a large dislocation, especially in a lot of liquid stocks. Coming to your question, yes, any sort of uncertainty market doesn't really like, and especially one which results in an elevated crude movement. That is where India is really vulnerable, right? Because we are importing, say, 1.4, 1.5 billion barrels of crude each year. A $10 up move is sort of a $14 billion to $15 billion hit, which is more than the money we would have gotten from the bond inclusion, which we are trying so hard for. So I think that is a predominant case which impairs India's sort of current account deficit, which in turn impairs sort of the interest rates. Now, if you look at the two policy rates in India, two policy rates, the US versus the India, then the difference is essentially below 100 basis points, which is the lowest we have ever seen. And therefore, anything that impacts India more than the US, which obviously crude price is, that has a potentially higher impact, relatively speaking, to equity valuations. And I think that is where the street is a little bit worried.
That's a good rationale coming from you, Jigar. Good afternoon, Mansi, this side. And of course, the prolonged conflict which we are at present witnessing, the Israel-Iran tensions and the bigger economies also interfering now, could stall global growth. But what is the stance for the domestic market like India? And where do you see India players stand, particularly sector-specific approach at present? If we have to build a portfolio, do you still say India is a buy on dips market? And if yes, what are the sectors to watch out for?
Right, Mansi. So I think, see, what's happening is that with sort of India, so to speak, is a macro darling in an otherwise turbulent market, right? So almost everything was completely aligned for the Indian macro space. The inflation had started to cool off. Your current account was in check. Fiscal deficit was tracking completely on track with the next year estimates. And therefore, in a world which is increasingly uncertain, India provided sort of a safe haven status. And therefore, incrementally, views were moving into earnings as well as sort of flows. Now, we can handle both of them separately, but earnings 4Q was a reasonably decent reality check. The only divergence we saw was that, the sectors where the weights was higher, they were not contributing as sharply to the incremental PAT growth of the free float BSE 500. If you looked at the sectors that did contribute, they were cyclical in nature. And therefore, despite sort of earnings beating consensus in more number of companies rather than missing, for the first time in 5 years, you are seeing consensus cut earnings, in the run up to the next year. So in starting COVID, you saw, consensus continue to raise or at least meet with their initial EPS targets 2 years out. So 2020, one estimate set out in 19 got met, 2022 got met, 23, 24 got met, 25 also got met, 26 and 27 is where we are seeing the earnings cut through, because I think incrementally consensus is not really confident on whether this cyclical revival that India is seeing will be able to push through over the next 2 years or not. And therefore, then sort of the focus moves to the flows. And within flows, we did talk about how FIs are incrementally putting in money. See, the DXY, which is the dollars gauge against the vast basket of currencies, that's sort of fallen from 110 to below 99. Now, if I'm a global allocator of capital and I'm seeing, emerging market versus developed market debate sort of rage on for 5 years and then shift, I am very wary that the dollar has now started depreciating. On top of that, I have an incumbent government who is keen on seeing dollar depreciate even further. And therefore, I will be keen to put money into emerging markets, and thereby India gets a higher allocation. Within domestic flows, everything said and done, we are only at around 4% of equity flows the household saving coming into equities. Uh, 10 years back, it was just 0.7. But in 1992, in the peak of those markets, we are almost 15%, albeit the volume was much lower. But even if this moves up to 10% in the foreseeable future, say 3-4 years from currently 4%, you're talking of 10 lakh crores of incremental flows coming into mutual funds or equities speaking. And therefore, I think despite earnings getting cut, in places where there is a reasonably decent sort of outlook, the valuations are not correcting in the face of apparent sort of construct that we are seeing.
All right, but Jigar, since you are highlighting the financialization of the saving trend that is shaping up in India, so do you believe that to play this, or rather to be a part of this particular trend, maybe someone can look at the brokerage and AMCs and they have a long way to go even from these levels?
That's for us, Srishti, that's sort of a slightly different view, right? Because so often a good product is a good company is a seamless transition. Like, let's say I wear Titan watch and therefore Titan as a company is good. And therefore, and the second generalization that a lot of people do is that because the company is good, it also a great investment. Our philosophy is pretty much based on cycles, and therefore what we pay to buy a business matters a lot to us. Many of these businesses are, quoting valuations, or when you do a reverse DCF on many of these businesses, you get a implied growth which is in sync with what the markets can deliver. So I think it's not as easy a transition, I would say, but yes, as a theme, it is interesting.
That's quite insightful, and I should say a 360-degree analysis on everything, right from the global perspective to the domestic market. Thank you so much for giving your time. Have a nice day.